After this module, you will be able to understand the concept of a base of a tax, and at the same time, you will also be able to understand what are the various taxes which are prevalent in India. First of all, let us understand meaning of base of a tax. Base of a tax is basically a measure, you can say actually a base on which valuation and determination of a tax liability is based. For example, any taxable income and assessed value of a tax is base of income tax as well as property tax respectively. Basically, no matter which tax you want to impose, you will have to have some ground level at the basis of which you will decide the tax which will be imposed. For example, as an individual, if I am earning some income or if I own a house or any pool of resources, for me that will be base of my tax. Now, after understanding the meaning of base of a tax, let's discuss the classification of various taxes which are prevalent in India. When we talk about classification of taxes, there are broadly two types, direct taxes and indirect taxes. As we were discussing indirect taxes, they are not paid directly by the person or organization on which they are imposed. Examples of indirect taxes are sales tax, service tax, excise duty, custom duty, value added tax, etc. The impact and incidence. And when we talk about impact and incidence, by impact I mean the initial burden, and by incidence I mean the final burden of the tax falls on discrete, that means two different entities. It is not necessary that on whom you are imposing the tax is actually facing the burden of tax also, which is in sheer contrast to the direct tax. In case of direct tax, when we impose tax on a person A, he only pays the tax. But in case of indirect tax, a person can actually shift the burden of tax on some other person. When we compare direct taxes and indirect taxes, it is considered that indirect taxes are comparatively regressive in nature because, as I explained, burden can eventually be shifted to the consumers who pay eventually the tax, and eventually the group on whom tax is imposed may not pay the tax. So burden is falling on a person irrespective of their income levels. Despite the fact that indirect taxes, in their case we can shift the burden, indirect taxes have a vital role in the economic development, since the direct tax collection in Indian context is low because of the low income levels in India. Now let us discuss the classification of direct taxes which are prevalent in India. The major direct taxes in India are as follows. Number one is personal income tax, then we have corporate tax, then we have minimum alternate tax, fringe benefit tax, dividend distribution tax, capital gains tax, property tax, etc. Apart from this, there are other taxes also, wealth tax, gift tax, which also come under the domain of direct taxes only. Now let us study each of these taxes in detail. So now I am going to elaborate on these taxes. The first tax, direct tax, which we will study and which is considered most important in Indian context, is the personal income tax. It is the most important type of direct tax, as I said, and it is levied on all types of income except for agriculture income, on which there is no direct tax as far as India is concerned. It is imposed under the Income Tax Act of 1961, and any individual who is an assessee, that means any person who is supposed to pay the tax and whose entire income surpasses the maximum exemption limit, because every year when budget is presented and finance bill is passed, exemption limit is set. So if your income is beyond that exemption limit, you will have to pay the direct tax as far as income tax is concerned. The income tax will be paid on the entire income of the preceding year, because we assess the tax in India for one complete financial year. Basically, income consists of individual income, Hindu undivided family income, also known as HUF, income on association of persons known as AOP, income on body of individuals known as BOI, income of the companies, income of the firms, income of the local authorities. That implies that any type of income you are earning from any source will be taxed under the Income Tax Act. As I told you, income tax is a yearly tax which is imposed every year, and assessment year begins from 1st April and finishes on the 31st March of next year. This clearly implies that we are considering about one financial year here. Income tax in India is designed under the provisions of Income Tax Act 1961. The Central Board on Direct Taxes, that is CBDT, designs income tax system in India. It is a statutory, that is legal authority of India, which works under the Central Board of Revenue Act 1963. The income tax is paid on the total income of person and is evaluated on the grounds of his or her residential status in India. A person is regarded as a resident if he or she stays in India for a defined period during a fiscal year, and here by fiscal year I mean a year which starts from 1st of April and ends on 31st of March. The prescribed period is either 182 days or more, or 60 days or more, depending on which tax is being imposed, and has been in India in aggregate for 365 days or more in the preceding 4 years. Any individual who does not meet these norms is considered as a non-resident. That means he will not consider to be a resident of India. Non-residents are taxed only on incomes that are received or are expected to arise in India and not on any other income. Next, let us talk about non-resident Indians or NRIs. Non-resident Indians don't need to file a tax return if their income involves only interest and dividends, on the condition that taxes are declared at source on such income. It is likely for non-resident Indians to gain of these distinctive provisions even after becoming residents of India by adopting certain procedures which are written and set down by the Income Tax Act of India. If you are a resident, your Indian income will be taxable and your foreign income will also be taxable. But if you are a non-resident of India, your Indian income will be taxable, but your foreign income will not be taxed. That means it will be non-taxable. The tax is imposed in respect of the income of the preceding year, that is in the financial year starting on 1st April and terminating on 31st March, and the same is chargeable in the assessment year also, that is the subsequent financial year, the year after the financial year for which you are being taxed. The taxable income includes the following heads which I am going to talk about. Number 1, your salaries. Secondly, income from house property, which is determined by reference to the annual value of property. Thirdly, profits and gains of business or profession. Fourthly, income which you are earning out of capital gains. And lastly, income from any other source. Foreign nationals who are employed in India are usually taxed on their Indian income only. Income received from sources which are outside India is not taxable unless it is received in India. The Indian tax laws deliver an exception of tax on specific types of income earned for services rendered in India. Next, foreign nationals have the choice of being taxed as per the tax treaties that India would have signed with its country of residence. Compensation for task which is completed in India is taxable regardless of the place of receipt. Here I mean by regardless of the place of receipt of income. Compensation contains salaries, wages, pension, fees, any type of commission, profits, addition to salary, any advance salary or any other type of privilege. The stock options granted by the employer are taxable as capital gains at the time of sales of shares attained due to the exercise of options. Next, we are going to talk about various tax slabs which are prevalent in India, and let me tell you, these tax slabs keep on changing depending on the annual budget which is presented by the finance minister in the parliament, and once the Finance Act is passed, accordingly tax slabs are determined every year. The various tax slabs or the rates of income tax are fixed by the Annual Finance Act, as I just told you, and rate of income tax applicable to different entities for the financial year 2012-13 are as: first, let's talk about the assessee. Assessee may be a male or female, but if your income is less than 2 lakh rupees, you will not be charged any tax. Between 2 to 5 lakhs, you will be charged at a tax rate of 10%. Between 5 to 10 lakhs, you will be charged an income tax at the rate of 20%, and if your income is exceeding 10 lakhs, you will be charged an income tax rate of 30%. There is some advantage according to your age. That means if you are a senior citizen, that means if your age is above the age of 60. So for people who are between the age group of 60 to 80, slabs are: if income is up to 2,50,000, no tax will be imposed. If income is between 2,50,000 to 5 lakhs, tax will be imposed at the rate of 10%. If income is between 5 lakhs to 10 lakhs, tax will be imposed at the rate of 20%. And if income is 10 lakhs or above, tax will be imposed at the rate of 30% or more. So in a way, we are giving some kind of concession on the basis of age in India. Thirdly, if you are a senior citizen but your age is above 80 years, then the tax concessions are even more. So if your income is less than 5 lakhs, that means we raise the slab here. If your income is less than 5 lakhs, you are not imposed any income tax. For an income between 5 to 10 lakhs, you are taxed at the rate of 20%. Now let's talk about the second type of tax, which is the corporation tax. Corporation tax, as the name only suggests, is levied on incomes of registered companies or corporations in the country, and the company may be a national company, a multinational company, or a foreign company. Since the company is given a legal status, corporate tax is a direct tax. In India, tax is imposed on nationalized companies on the basis of their aggregate incomes regardless of its source and origin. Tax on overseas companies are imposed on incomes that arise from procedures taken in India. A company is referred to as a juristic individual having an autonomous and distinct legal entity from its shareholders. The earnings of the company is calculated and assessed independently in the hands of the company. However, the earnings of the company which is dispersed to its shareholders as dividends is evaluated in their specific hands. The division of earnings is not regarded as expenditure in the hands of company. The earnings so dispersed is an appropriation of the proceeds of the company. Now, when we define the residence of company, let me explain the concept in a bit detail. A company is said to be a resident in India during the relevant previous year, means during the year for which we are imposing the corporate tax, if number 1, it is an Indian company, or if it is not an Indian company but the control and management of its affairs is situated wholly in India. A company is said to be non-resident in India if it is not an Indian company and some part of the control and management of its affairs is situated outside India. The taxability of a company's earnings is determined by its domiciles. Companies in India are taxable on their global income. International companies are taxable on earnings which is generated out of their Indian procedures, or in few cases incomes that is considered to arise in India. Royalty, interest, profits from sale of capital assets situated in India, which mainly comprise of profits from sale of shares in an Indian company, dividends from Indian companies, and dues for technical services that are regarded as earnings arising in India. Domestic organizations are subject to tax at a base rate of 35%, and on this tax a surcharge of 2.5% is levied. As far as foreign corporations are concerned, they have a base tax rate of 40%, and on this 40%, 2.5% surcharge is levied. Furthermore, an education cess at the rate of 2% on the tax payable is also charged as a part of corporation tax. After talking about income tax and corporation tax, now we are going to talk about third type of tax, which is the minimum alternate tax, also known as MAT. Generally, a company is likely to pay tax on the earnings computed in conformity with the provisions of the Income Tax Act, but the profit and loss account of the company is prepared as per requirements of the Companies Act. There were a huge number of companies in Indian context who had book profits according to their profit and loss accounts but were not paying any tax, since income computed in line with the provisions of the Income Tax Act remained nil, negative or irrelevant. In this case, though the companies were displaying book profits and therefore announcing dividends to the shareholders, they were not paying income tax. These companies are well known as zero tax company, and to bring such companies under the Income Tax Act, Section 115JA was presented with effect from evaluation year 1997-98. A new tax credit scheme is introduced by which minimum alternate tax or MAT paid can be carried forward or set off against regular tax payable during the subsequent 5-year period, subject to certain conditions which I am going to talk about. Firstly, When a company pays tax under MAT regime, the tax credit earned by it shall be an amount which is the difference between the amount payable under MAT and the regular tax. Regular tax in this case means tax payable on the basis of normal compensation of total income of the company. Secondly, MAT credit will be allowed carry forward facility for a period of 5 assessment years immediately succeeding the assessment year in which MAT is to be paid. Unutilized minimum alternate tax credit, that is MAT credit, will be allowed to be accumulated subject to the 5-year carry forward period. Thirdly, in the assessment year, when the regular tax becomes payable, the difference between the regular tax and the tax computed under minimum alternate tax for that year will be set off against the MAT credit available. Fourthly, the credit allowed will not bear any interest. These were the 4 main features of MAT regulations in India. Corporations in India pay minimum alternate tax at the rate of 7.5%, which includes surcharge, and education cess, which is imposed at the rate of 2%. And this 7.5% is proportion of the book profit which a company is earning in a assessment year. If the tax is to be paid as per consistent tax provisions is below 7.5% of its book profits, even then you will have to pay a minimum tax of 7.5%, and that is what justifies the name of minimum alternate tax. Fourthly, I am going to talk about another type of direct tax which is there in India, known as fringe benefit tax and abbreviated as FBT. As far as fringe benefit tax or FBT is concerned, the Finance Act 2005 announced this tax under Chapter 12H, Section 115W to 115WL, which is a part of Income Tax Act of 1961. Now let me elaborate on the features of fringe benefit tax. It is an additional income tax. That means it is over and above the income tax which a person is supposed to pay or a corporation is supposed to pay, which is to be paid by the employers on the value of fringe benefits delivered or considered to have been delivered to the employee. It is to be paid by an employer who is a company, a firm, an association of individuals exclusive of trusts, a body of individuals, a local authority, a sole trader, or an artificial judicial individual. It is payable even when the employer does not otherwise have taxable income. Fringe benefit tax you have to pay. Fringe benefits are exempted as any privilege, otherwise any privilege, service, facility or amenity directly or indirectly provided by an employer to his employees, including the former employees, by the reason of their employment and company's expenditure or payments on certain indicated heads. Further, fringe benefit tax is payable on a predefined percentage on the taxable value of total fringe benefits received. Besides, surcharge in case of domestic and foreign companies will be imposable on the sum of FBT, that is fringe benefit tax. On these sums, education cess will also be payable. Every company is required to file a return on fringe benefits to the assessing officer in the prescribed form, which is prescribed in the Income Tax Act, by the 31st October of the assessment year according to the provisions of Section 115WD of the Income Tax Act. If the employer fails to file a return within a specific time period mentioned under the said section, that is 115WD, he will have to accept the penalty which is levied in the sections. The next tax which we are going to discuss in this module is the dividend distribution tax, also known as DDT. It is levied under the section 115O of the Income Tax Act. Any sum announced, disbursed or paid by a domestic company in the form of dividend would be imputable to the dividend tax. One thing which is important about this DDT or the dividend distribution tax is that it is imposed only on the domestic companies, and in India we do not impose DDT on the foreign companies. Tax on allocated profits is in addition to the income tax imputable in regard to the entire income. It is valid income whether the dividend is interim or else. Similarly, it is valid whether such dividend is paid out of current profits or whether the dividends are paid out of accumulated profits. About dividend distribution tax, the tax has to be deposited in 14 days from the date of announcement, dispersal or payment of dividend, whichever is first, failing to which will need payment of stipulated interest for all the months of delay as per the section 115P of the Income Tax Act. Now we will discuss the rates on DDT. The rate of dividend distribution tax is 15% on dividends divided by domestic companies and 25% on dividends which is paid by the money market mutual funds and liquid mutual funds to all investors. Next tax which we are going to discuss in this module is capital gains tax. It is the profit which we earn from any type of sale of capital assets. When we tax those profits, we call it as a capital gains tax. The tax is applicable in the year in which the sale of capital assets take place. Capital assets are all types of assets. That means we will include the movable assets as well as immovable assets in the definition of capital assets. For example, business stocks, paintings, jewelry, ornaments, your house or a farmhouse. The capital gain or net profit which is taxable is the difference between the price at which asset is sold and the price at which it was purchased. So the difference between the selling price and the buying price is nothing but the capital which you are gaining, and if this gained capital is taxed, we will call it capital gains tax. A capital gain can accrue owing to the sale of a short-term or a long-term capital asset. A capital asset is a short-term capital asset. Now I am going to define it. If it is sold in 3 years or 36 months from the date of purchase. Though in the case of mutual funds or company shares, the allowed time duration is not 3 years, rather it is 1 year. If the time period of sale of a capital asset exceeds 3 years, and in case of mutual funds or company shares it is 1 year, then it is defined as a long-term capital asset. That means if it is less than 3 years, we will call it short-term capital asset, and if it is more than 3 years, we will call it long-term capital assets. And in case of mutual funds, rather than 3 years, we are going to take the 1 year as the dividing line between long-term and the short-term. Long-term capital gains are taxed at a basis rate of 20%. However, long-term capital gains from the sale of equity shares or units of mutual funds are not taxed, that is, they are exempted from capital gains tax. Tax is imposed on short-term capital gains at the normal corporate income tax rates which are given in the income tax law, short-term capital gains rising on the transfer of equity shares or units of mutual fund are taxed at a rate of 10%. After capital gains tax, the next tax which we are going to discuss in this module is the property tax. Now let me first define the concept of property. Property is considered a source of income in India because you own it, and therefore it is a source of income to you, and as per the Income Tax Act, tax is imposed on the income which you earn out of your property. The property tax is measured on the value of the property. Vacant plots, that means those plots on which no construction has been made and without any neighboring building, are not liable to property tax as far as Indian tax law are concerned. Tax is imposed on vacant plots as income from other sources. The properties that are liable to be taxed as property tax in India are residential houses. They may be self-occupied, that means you may be living in them. They may be let out houses, that means further you have rented those houses to others. The office buildings, the factory buildings, any type of warehouses or godowns, flats, shops, all these come under the domain of property tax. There isn't any comprehensive system of property taxation. Not only does it differ among the states, that means it varies from state to state, but it also differs among the municipalities within the states. For leased properties, property tax is levied on the annual rented value of the property. In Delhi, property tax ranges from 6% to 10%. This is one example of property tax. That is why I am giving you example of Delhi. Next tax which we are going to talk about, and here we are discussing the direct taxes. Next tax is the wealth tax. Wealth tax is imposed under the Wealth Tax Act of 1957. Let me define the wealth tax to you first. It is a tax on the profits derived from property ownership, whether such property yield any income or not. Tax is to be paid year after year on the same property at the market value. Under the Act, the tax is imposed in context of the wealth held during the assessment year by the following persons. Number one, individuals. Secondly, HUF, that is Hindu undivided families. And thirdly, by the companies. This tax also depends upon the residential status of the assessee. That means the person who is supposed to pay wealth tax. Likewise, the resident status of the for the objective of the Income Tax Act. Further, we are discussing wealth tax here. It is not imposed on productive assets. Therefore, any type of investment in shares, debentures, UTI, that is Unit Trust of India, mutual funds, etc. are exempted from wealth tax. The assets are accountable to be taxed as the, now I am going to give you the examples, are guest house, residential house, commercial buildings, motor car, jewelry, bullion, that is gold reserve, utensils of gold, silver, yachts, boats and aircrafts, urban land and cash which is in your hand and which exceeds the amount of 50,000 for individuals and undivided Hindu families only. Now there are some exemptions in the wealth tax, and the exemptions are: number one, assets which are kept as stock in trade. Secondly, a house which is used for business or profession. Thirdly, any property which is in the form of a commercial complex. Fourthly, a house which is lent for more than 300 days in a year, a gold deposit bond, and lastly, a residential house assigned by a company to any employee or to any officer which is working with the company. Net wealth tax, now I am going to talk about the rate of wealth tax. is imposed at 1% on a taxpayer's net assets if it goes beyond rupees 10 million as of 2012. Rupees 10 million. If it goes beyond rupees 10 millions as of 2012. The last direct tax which we are going to discuss is the inheritance tax. Also at times it is named as gift tax. There are certain exemptions in case of inherited tax. That means, for example, money received from relatives is non-taxable. It also exempts the marriage gifts. That means any gift which you are receiving at the time of your marriage will not be taxed, and the money received through inheritance from gift tax. Formerly, inheritance tax was in practice, but now inheritance tax has been abolished by the government. After discussing all the taxes in detail, now we will summarize everything which we have studied in this module. First of all, we discuss the concept of base of the tax. That means on which basis tax is imposed. It may be income, wealth, inheritance, etc. So we can say the base of a tax is an amount upon which the valuation or determination of tax liability is grounded. After discussing the base of tax, next we discuss the concept of a direct tax, and then it was explained to you that direct tax is a tax which the central government takes directly from the taxpayer, and they have to be paid by the individual on which they are levied. They are in stark contrast to the indirect taxes, where the individual is able to shift the burden of the tax on some third party. In India, we have a number of taxes, and firstly we discuss the concept of income tax. Income tax comprises all tax on all income except the agriculture income, and income tax is imposed and collected by the central government. Corporate tax is levied on the earnings of registered companies or corporations in the country. The corporations or companies may be national, multinational or foreign. Next, under section 115O of the Income Tax Act, any sum declared, allocated or paid by a domestic company in the form of dividend will be eligible for a tax known as dividend distribution tax or DDT. Next, we talked about profit tax. Profit tax is a tax generated from the sale of capital assets and are taxable as capital gains. Property is also considered to be a source of income in India. Therefore, property tax is imposed on the income which is earned from the property. A tax which is on the profits received from the ownership of property is known as wealth tax. Whether such property is actually yielding income or not does not matter, and tax is to be paid every year on the same property on its market value, and income exceeding the amount of 50,000 received without contemplation by an individual or a Hindu undivided family from any one, and winnings from the lotteries and interest income is subject to gift tax as the income under other sources. Thank you.